Welcome to the debate. If you have been anywhere near a financial news feed, a trading desk, or a crypto Twitter timeline recently, you haven't just seen the red candles, you've really felt the palpable panic in the air.
Oh, absolutely. It's thick.
Right. We are witnessing a psychological phenomenon that hasn't occurred with this specific intensity since, probably since the absolute depths of the FTX collapse. The data is just screaming it right now. Google searches for Bitcoin is dead and Bitcoin is going to zero have gone absolutely parabolic, hitting all-time highs. And to the uninitiated, or the retail investor checking their portfolio in horror this morning, this looks like the end of the road. But to the historian of markets, this looks like something else entirely. It looks like a signal.
It certainly looks like a signal, but interpreting that signal is where you and I are going to disagree today. We are seeing extreme negative sentiment, yes, but we have to ask ourselves a very uncomfortable question here. Is this the irrational panic that marks a bottom, or is it a totally rational reaction to an asset class that is fundamentally struggling to find its footing? I mean, you mentioned FTX, but the context here is entirely different. We aren't dealing with a massive fraud uncovered overnight. We are dealing with a slow, grinding bleed.
And that distinction is exactly the central question we are tackling today. Is this extreme sentiment a sign of a dying asset class, or does it represent a wall of fear that historically precedes a massive market reversal? I'll be arguing that it's the latter. I'm looking at the intersection of pending Supreme Court rulings on tariffs and whale accumulation. And where you see a bleed, I see a contrarian buy signal flashing neon green.
And I look at that exact same chart, and I see a market that has endured 6 consecutive months of red candles. A record, I might add. That is half a year of pure downside. I'll be arguing that while I appreciate the contrarian impulse, it's very romantic to buy when there's blood in the streets. Relying on complex political outcomes and historical patterns while ignoring the severity of the current price action is just a dangerous game. I am here to argue for caution, not heroism.
I see why you think that. I really do. But let me give you a slightly different perspective on the current state of the market for my opening position here. We are literally rising into a wall of fear. The data is stark. Retail sentiment is at rock bottom. People are capitulating. They're typing Bitcoin is going to zero into search bars because they are scared. And honestly, they are exhausted.
Yeah.
But while retail is panic selling, the on-chain data tells a completely different story regarding whales, specifically entities with balances over $1,000. They have been buying this dip consistently, and they are doing it because they see a massive macroeconomic shift coming, specifically the analysis from Tom Lee regarding the Supreme Court striking down the recent tariff increases. Removing those tariffs cools inflation, and it allows the Federal Reserve to finally shift from hawkish to dovish and cut rates.
Well, buying the dip is a noble strategy until you run out of capital. We've seen whales be wrong before. Just because someone has a lot of money doesn't mean they are immune to market gravity. My position is grounded in the brutal reality of the recent price action. We just faced a record 6 consecutive months of decline. Look at Ethereum's performance as a specific warning sign. 2025 was Ethereum's worst year on record, with 11 out of the last 14 months being red. To ignore that and rely on a suddenly dovish Fed is highly speculative, especially given how the Fed has struggled to establish inflation credibility since 2022. I suggest that the extreme Bitcoin is dead search volume might not be a clever contrarian signal at all. It might just be a reflection of retail investors finally capitulating because the asset is failing them.
Okay, but let's dive into that macro setup because I think it's the linchpin of everything happening right now. Let's talk about the tariffs. President Trump has raised global tariffs, moving from 10% to 15%. Now, the consensus view is that this is terrible for markets because it increases costs. But the contrarian view, the Tom Lee analysis, is that the Supreme Court is actually likely to strike down these tariff increases as executive overreach.
Okay, let's stop there for a second. You are hanging a massive amount of hope on a judicial ruling. Even if the Supreme Court strikes down the tariffs, how does that translate to a Bitcoin pump? How does a court ruling in Washington save the price of a decentralized asset?
It's the economic domino effect. If the Supreme Court strikes down the tariffs, 2 massive things happen simultaneously. First, It serves as a limit on executive powers, which markets generally appreciate. It removes uncertainty. But more importantly, and this is the vital part, it cools the inflationary pressure that tariffs inherently create. Tariffs are effectively a tax that raises the price of physical goods. If you remove that goods inflation, you allow the Federal Reserve to shift from hawkish to dovish.
You're saying it gives the Fed permission to cut rates.
Exactly. It gives them the room to cut rates without looking weak on inflation. A dovish Fed, plus a job market that is already softening, is the perfect storm for a crypto revival. It unlocks global liquidity. Lower cost of capital means risk-on assets fly.
I'm sorry, but I just don't buy that chain of logic. It feels like a very sophisticated Rube Goldberg machine. You need the court to rule a specific way, you need the market to interpret that as disinflationary immediately, and then you need the Fed to pivot based on that single isolated factor.
It's not isolated, though.
But the Fed doesn't just look at goods inflation caused by tariffs. They are looking at services inflation. They are looking at sticky wages and housing. They have been incredibly hawkish for years to prove they can fight inflation. Assuming a rapid pivot to rate cuts based on a Supreme Court ruling regarding tariffs seems wildly optimistic.
But the market trades on the margin. The removal of the tariff threat is the marginal change that shifts the narrative. Technology, software, and crypto are sectors that have been largely shielded from the original tariff impacts anyway. They aren't moving physical goods across borders in the same way manufacturing does. So if the cost of capital comes down, these assets re-rate higher almost immediately.
Sure, they don't move steel, but they move on liquidity. And right now, liquidity is drying up because people are terrified. I want to go back to the Bitcoin is dead search volume you started with. You see that as a bottom signal. I see that as a reflection of retail investors finally capitulating after months of losses because they are functionally insolvent. It's not just bad sentiment. It's a lack of literal dollars to put into the market.
That's an interesting point, though I would frame it very differently. Capitulation is the bottom. When the weak hands, the people frantically searching, is Bitcoin dead? When they sell, who is buying? The strong hands. The transfer of wealth goes from the impatient to the patient.
Unless the strong hands are also just sitting on their hands waiting for $50,000.
But they aren't sitting on their hands. Let's look at the on-chain reality, not just the emotional candle charts. I want to focus on the $67,000 price point. This is crucial data. According to recent analysis, this is now the most transacted price in Bitcoin's entire history. Over 600,000 Bitcoin, which is 3% of the total supply, has moved at this specific level.
Okay, let's unpack that. 600,000 Bitcoin moved. That means high volume. But high volume at a price level isn't automatically bullish. It just means a lot of coins changed hands. It could easily mean that whales are distributing their bags to a new generation of bag holders who are about to get absolutely wrecked. Why are you so sure it's accumulation and not distribution?
Because of who is doing the moving. We track the wallet sizes. We are seeing wallets with significant history and massive size stepping in to buy. When 3% of the supply changes hands at a specific level, it turns previous resistance into a concrete floor. Just 3 weeks prior, that area only had 200,000 Bitcoin transacted. The volume has tripled. That tells me the market is collectively deciding that 67,000 is fair value. The floor is being poured with concrete while everyone else is panicking.
Concrete floors can crack if the earthquake is big enough. And I have to point out the ceiling here. You talk about the floor at 67,000. I am looking at the massive resistance overhead. The market still needs to break through 87,000 to turn that into support before we can even whisper about all-time highs. We are trading in a highly dangerous range, and every time we bounce, we set a lower high. That is the literal definition of a downtrend.
We break resistance by building support higher up, which is exactly what this consolidation at 67,000 is doing. It is absorbing the selling pressure.
Or it's exhausting the buyers. Once those buyers at 67,000 are fully allocated, who is left to bid? If we drop below this so-called concrete floor, the next stop isn't 65,000, it's likely 50,000. That is a structural risk you aren't acknowledging.
I acknowledge the risk, but I weigh it against the underlying scarcity of the asset. And this brings up a wealth gap statistic that I think is vastly overlooked right now.
Owning just 3 Bitcoin today places a person in the top 1% of US earners in terms of net wealth, simply because the top 1% now hold more wealth than the entire middle class. The concentration of wealth means that acquiring this asset is becoming mathematically impossible for the average person.
That is a staggering stat, I will grant you that. But let's be real. Does that matter to the market right now? Warning against panic selling by telling people they are in the top 1% feels good. It appeals to the ego. But it doesn't stop the portfolio drawdown. It sounds like a slick marketing pitch to keep people from selling. Don't sell, you're elite. Meanwhile, your net worth is dropping 5% a week.
It is not a marketing pitch, it is a reality check on absolute scarcity. If you sell now, you are selling an asset that is statistically harder to reacquire than almost anything else on the planet.
But scarcity alone doesn't create value. Water is scarce in the desert, but if you're drowning in the ocean, you don't care about water. Right now, the market is drowning in red candles, and I have to warn against these fantasy targets held by what the source material calls dumb money. Just because the asset is scarce doesn't mean the market can't reprice it significantly lower in the interim.
I'm not convinced by that line of reasoning because it completely ignores the behavior of the smart money. You keep saying price is dropping, but the smart money is buying. If the price was destined to go to 50,000, why are entities with over 1,000 Bitcoin in balances accumulating heavily right now? Why is the volume spiking right here?
They might be dollar cost averaging over a 5-year horizon. BlackRock can afford to be underwater for 2 years. Can the average listener? That is the difference.
Well, let's look at history then to gauge the timeline. Let's talk about the green after red argument. We have just seen a record 6 consecutive red months.
Which is terrifying. That is serious downward momentum.
It sounds terrifying until you look at the historical precedent. Historically, when we have seen such streaks, even going back to 2015 or 2018, they have been followed by significant green streaks. The source data notes that the record of 6 consecutive red months has historically been followed by 5 consecutive green months. This is mean reversion. The rubber band is stretched way too far down. This is the time to back up the truck, not to sell in a panic.
I'm sorry, but you simply cannot treat financial markets like physics. There is no law of gravity that says what goes down must come up. Just because a ball bounces after hitting the floor doesn't mean a financial market rallies after crashing. The fact that 2025 tied with 2018 for incredibly poor performance suggests a deep structural weakness, not just a cyclical dip.
But 2018 was followed by a massive, multi-year recovery.
Eventually, but the pain in the interim, the crypto winter wiped people out. The silver lining of Ethereum's past performance, 5 green months following a crash, is not a guarantee. It is a probability, and right now the momentum is undeniably downward.
But you are ignoring the fundamental growth occurring right beneath that price action. There is a massive disconnect in the market, specifically with Ethereum. You mentioned the red months, and you are entirely focused on price. But have you looked at the plumbing of the network? I'm talking about real-world assets, or RWAs.
I see the buzzword everywhere, sure.
It is not just a buzzword. We are talking about United States treasuries, private credit, and actual corporate debt being tokenized on-chain. The market cap of RWA on Ethereum just surpassed $15 billion. That is up 200% year over year. This isn't people trading monkey JPEGs anymore. This is BlackRock. This is institutional finance permanently moving onto the rails. On-chain metrics are literally more bullish than they have ever been.
Okay, let me challenge you on that exact point. If the fundamentals are so incredibly strong, if $15 billion in real assets are sitting on Ethereum, why is the price performance the worst ever over the last 14 months? Why is there such a massive divergence between this amazing utility you claim exists and the price people are actually willing to pay for the token?
Because sentiment lags reality. The market is pricing in fear of regulation and fear of the macro environment, entirely ignoring the fact that the underlying network activity is stronger than it has ever been.
Or perhaps the smart money isn't valuing those metrics as highly as you are. Maybe the token itself doesn't capture the value of the treasuries sitting on the network. If I buy a tokenized treasury on Ethereum, I get the yield from the treasury. I don't necessarily need to hold ETH to do it other than to pay for a tiny bit of gas. The fact that the price isn't moving suggests that the speculative premium is washing out of the market and we honestly don't know where the true floor of utility value actually lies.
I would argue the floor is being established right now by the political landscape, which is finally shifting in our favor to unlock that value. We have the White House setting a March 1st deadline to resolve stablecoin disputes. They are actively pushing for a crypto market structure bill by April. This is legislative clarity we have quite literally never had before.
Deadlines in Washington are notoriously flexible. March 1st can very easily become sometime in the fall or even next year.
But the intent is there, and look at the geopolitical pressure. You have Trump explicitly stating that the U.S. must be #1 in crypto to compete with China. He said, and I quote, "There is no second place. This reframes crypto from a speculative casino asset to a strategic geopolitical asset." That is a massive game changer.
It is rhetoric. Politicians say whatever they need to say to get donors and votes in an election cycle.
It is rhetoric that actively drives policy. Even Biden had to pivot, late, admittedly, but he shifted his policy because the voter bloc demanded it. Trump's campaign noted that Biden's team realized they were losing the crypto vote and frantically tried to switch stances. The political will is moving toward adoption because there is simply too much money and too many single-issue voters involved now to ignore it.
I view the political landscape as volatile, not favorable. Politicians change stances constantly. You just admitted Biden did exactly that. And Trump's claim that there is no second place. Sure, it sounds fantastic on a stump speech, but does it solve the immediate fear in the market today? Does it fix the 6 months of red candles? No. It adds geopolitical pressure, but it doesn't print money to buy the dip.
It provides the framework for the rebound. When the U.S. government signals that this industry is a strategic priority, the regulatory risk premium just evaporates.
It provides headlines. And right now, the headlines about tariffs and trade wars are creating tangible, heavy economic risks that outweigh the promise of a crypto bill in April. The Bitcoin is dead sentiment is extreme, I grant you that. But that wall of fear is built on the reality that regulation is still messy, regardless of what candidates promise on the campaign trail.
I think you are vastly underestimating the speed at which this sentiment can shift. We are looking at a market transitioning from early adopters to the early majority. That is the grand macro thesis here.
And that transition is painful. It is where the bodies are buried.
It is painful, but it is deeply profitable for those who survive it. Look, with Bitcoin and its dead searches peaking, literally going parabolic, history tells us this is usually the point of maximum financial opportunity. When everyone is desperately looking for the exit, the door is usually opening for the entrance. When you combine the legislative clarity coming in March and April with the potential for favorable macro shifts regarding the Supreme Court, tariffs, and the Fed, the setup is incredibly asymmetric to the upside.
And I remain deeply cautious. The wall of fear is very real, but so are the economic headwinds. While I admit the sentiment is contrarian, blindly following historical patterns, like the green after red theory, is risky when we are facing unprecedented executive versus judicial clashes in Washington. Smart money buying is a good sign, absolutely. But it doesn't prevent further short-term pain for the average investor.
And that is the crux of the debate. We have a massive divergence between sentiment, which is purely fearful, and the underlying data, which shows deep accumulation and fundamental growth.
Precisely. And listeners have to look at the evidence and decide if that parabolic fear is a clear signal to exit before it gets worse, or the exact signal they have been waiting for to enter the market.
The story of Bitcoin and crypto is far from over, and usually the best chapters are written right after the darkest moments.
Indeed. But the next chapter might be a lot of volatility before we finally get to that redemption arc.
That brings us to the end of today's discussion. Thank you for listening to The Debate.
Until next time.